Hi, I'm Katie Malin with Pack Tax South Ogden, and I'm here today to talk to you about HSAs. They're one of my most favorite tools out there. I love them, love them, love them, and I highly recommend taking advantage of them if you have the ability to do so. There's some caveats as to what you do need in order to be able to take advantage of them, however. In order to have an HSA, you must have a high deductible health plan. So those limits on what constitutes a high deductible health plan change every year, and those are dictated by the IRS. So for 2025, the minimum deductible that you have to have if you're single is $1,650. Married, filing jointly, or family plans really are $3,300. That's what your deductible has to be in order to be qualified health plan to have an HSA account. Then, once you have that HSA account, they also put limits on how much you can contribute to the HSA account. So annually for 2025, for a single person or taxpayer only plans, you have $4,300 that you can contribute. If you're married, filing jointly, or a family plan, again, is $8,550 is the max you can contribute. If you're over 55, however, you can do a $1,000 bonus contribution, like a catch-up contribution, I believe is what they call it. Here's some of the things that I really love about an HSA plan. One is that they're invested. So you can actually have gains within your HSA plan. So it builds beyond just what you're contributing to it. And there's a lot of employers that will contribute also on your behalf. Your HSA account is invested. We love that. We love anything that's going to gain, we love. Here's the other thing. Once you've turned 65, you can use the money in your HSA account on anything you want. That being said, anything you use it for that isn't a medical expense, you will still pay income tax on. But you will not pay any kind of penalties. For example, let's say now, because I'm under 65, obviously, I were to spend money out of my HSA account on something other than medical expenses, I would have to pay income tax on the money that I spent and a 20% penalty. 20%, which is 10% higher than what the penalties are if you take money out of your IRA. So do whatever you can to not use HSA money under the age of 65 on anything other than medical expenses. Let's talk about what you can spend it on. The list is limitless. Massages, acupuncture, over-the-counter meds, co-pays, prescriptions, glasses. If you have to travel for like a long distance for a medical issue, you can write off some of the travel using your HSA account. So it's just an amazing tool that everyone should take advantage of. Now, here's my personal opinion, and that's all this is. But if you can contribute as much as you can to your HSA account and not spend it under the age of 65, it's like having a bonus retirement account that is just growing. On top of which, let's be honest, a large portion of the expenses you're going to have as a senior are medical expenses. So rather than using the money on over-the-counter meds and co-pays and prescriptions, if you can afford to just pay for those in cash currently, hold off on using your HSA if you can. That way, once you've turned 65 and you have all these giant medical bills, or once you retire, I guess I should say, then you have an excess of money available to you to help cover medical bills and expenses as a senior citizen. It's one of the best tools out there, in my opinion. Take advantage all day long if you can. Most employers offer an HSA that you can use in-house. Now, let's say you don't want to use their in-house HSA account. You absolutely can do that outside of your employer, or let's say you're self-employed. You can absolutely set up an HSA account, and most financial planners offer that service. It's very easy. Let's say you move employers. Like, you get to take your HSA with you. They're yours. You own them throughout your whole life. So they're unlike an FSA, flexible savings account. It's not use it or lose it. An FSA, it only lasts through the calendar year that you've contributed money into it. An HSA, it rolls over each year and you take it with you. So it's glorious. Say you're self-employed and you have insurance through Marketplace. You can go to your financial planner and set up, or a lot of banks even will have it, or credit unions, where you can set up an HSA account through them. So hopefully I've given you lots to think about with your HSA. Like I said at the start of this, they are one of my most favorite tools. Use them, use them, use them. Try and hold off on using them for minor things throughout your lifetime so that they build and grow. Make sure they're invested. Don't just have them sitting there. Make sure they're invested so they can grow with you as well. Start early. Like all investments accounts, the sooner you get in, the better you are off. So start early, start those HSAs early. Try not to spend them. Use them if you need to, right? The whole purpose of a HSA plan is really to cover that high deductible, right? So if you have a major medical event, you have the money there saved for you to cover the full deductible on major medical events. But try to avoid using it on the small stuff. And that way, once you hit retirement and it's grown and you haven't spent it, you'll have all this money that you can use for your more expensive time of life when it comes to medical expenses, let's be honest. So take advantage, start early, embrace it. They're a thing of beauty. I love them, love them, love them, and enjoy.